Welcome everyone to another Maine SBDC webinar. My name is Kelsey Reardon and I'm with the USM State Office. And today we have Maine SBDC at CEI Business Advisor Raynor Large to go over the thrilling topic of business financing 101. So financials. We're going to be going over the basics, getting you a little bit more familiar with what goes into some good financial awareness. Yesterday was National Financial Awareness Day. So thanks for coming to celebrate with us. We are the Maine Small Business Development Centers, and we provide no cost to you confidential business advising. So we're an SBA funded program, and we have centers throughout the state and advisors at each center, and they can answer just about any small business question you have. And if we can't answer your question, we can find somebody who can. So we can't give legal or accounting advice, but we have a lot of advisors, Raynor included, who really love financials. And so they are happy to go through it with you. They'll be kind of like disgustingly giddy at some point when a spreadsheet shows up and you'll be like, this doesn't make any sense. And they'll be like, but this is the best part. And so that's why we have them teaching these classes, so that it seems a little bit more approachable and accessible for everyone. And so our business advisors can help with a whole range of topics, but we are still meeting mostly via Zoom, so we're not as locked into the geographical location for the advisors. So we may have an advisor who specializes in your industry or an issue that you're facing, and we can get you connected with that. So I'll be sending out a follow-up email likely tomorrow that will include a link to the recording as well as the slides in the presentation and all of our contact information. So if you're not already set up with a business advisor, there'll be a link just to click through there and we can get you all set up in the system. But I'll also include Raynor's contact information. So if you have any very specific questions, I'm sure he would be happy to help. Feel free to put any questions you have along the way in the chat. We usually stop and see if there's any questions along the way, but there'll definitely be time at the end if anything is unanswered. But otherwise, I think we are ready to get started. So I'll pass it over to Raynor.
Perfect. Thanks, Kelsey. Yeah, I just wanted to reiterate a couple points as Kelsey was going through it. This is the first time we've actually offered this particular seminar, so I've included a ton of information that I'm going to go through and cover it in probably too much detail, but I enjoy talking about it. If you do need to hop off at 3 o'clock, that's totally fine. We're going to send you the recording. We'll send you the entire recording. And then all of our best work is really done one-on-one. As much fun as these seminars are, all of the other advisors, myself included, really just enjoy talking about you in particular and your business and how the lessons that we teach and how we can help really pertain to what you're doing. So we'll talk about some generics, some kind of top-down overview of how to use these financials. But if you really want to apply the lessons and you have those questions or details to dig into, please reach out. It's free, it's confidential, we're here for you. No limit on how you use us. My specialty is in kind of the financial side, but we have people who are excellent at marketing. We have people who are great at human resources. We collaborate all the time together. So if you have a question about your business, how to run your business, the direction it's going in, we're a sounding board, right? And that's exactly what we're here for. So excited to dive in today. Please go ahead and just mute yourself if you're not asking a question. We don't have that many people on today, which is great. So if I'm glossing over a subject or you have a question and if I'm not answering it in the chat because I'm really involved in just going about it, interrupt me, take yourself off of mute and just flag me down. Happy to answer any questions as they come up. And like I said, the more pertinent it is for you, the better off we all are. And I'm sure the questions that you have are also questions shared by other people attending. One thing that I would just put out there is I'm not an accountant. I'm not a CPA. I've done a lot of work in troubled asset management and turnaround, a lot of financial projections, a lot of business valuation and understanding how the financials impact the value of the business. So that's the lens through which I see this. It's really an operational performance and how you're using these financials to drive your behavior, to make your decisions. So that's going to be my focus through this. If you need tax advice, if you need particular advice regarding how to file, push those questions back to your accountant. I'm here to teach you how to kind of run a business as a CFO, as an operating person, using these as the tool, right? So we're going to talk a little bit about the theory, why I get so passionate about this, why I think it's such an important part of running your business. We'll talk about the basics, 3 financial statements, why they're broken down like that, which ones you should be focusing on. And then a couple of things right at the end, kind of using your financials. How do you use the information, the groundwork, the base knowledge to drive that decision making, to set measurable goals for yourself and then hold yourself accountable? So why bother, right? That's the first question I have. Isn't this something that I just pay a bookkeeper for? Isn't this something I can push off on my spouse or someone else to just keep on top of this and then file my taxes at year end? There's 3 reasons that I kind of have boiled this down to as to why the financials are so critical, right? Why this is the underlying driver for your business and understanding. One is external, right? That's the one I start with. Anytime you have a conversation with someone in the business community externally, it boils down to the financials. You have to be able to speak that language, right? If you're planning on borrowing money from a bank, if you have a partner or an investor that you're thinking about working with, you know, if you're thinking about selling your business at some point, if that's your exit strategy, or, you know, you're looking at a big tax burden and you're talking with your accountant to try to mitigate or reduce your taxes a little bit in a legal and, you know, official way. All of that requires this understanding of how the financial statements work, where your profit margin is, how profitable you are, and where your strengths are financially. So external, right? Reason number 1. You have to be able to speak that language to communicate all of that intuition that you have to someone else. The second reason is that it's really the best way to have an apples to apples comparison of all of those decisions that you're trying to make day to day, right? The idea of, do I add a second location, or do I go online, or, you know, do I integrate vertically or horizontally? Do I add another product? Where are my loss leaders, right? What kind of products am I losing money on? Which am I most profitable? Where should I focus my time and energy? All of those questions boil down to 2 things, right? It's a cost, right? The cost of making that decision of moving forward, and an intended impact. Now, both of those are financial. You're saying, okay, what do I spend to you know, invest in this marketing outreach, to reach this new demographic of consumers, to hire another employee, and what is my intended outcome? Am I driving sales? Am I controlling my costs? Am I reducing my overhead? Right? What does that look like to my bottom line? Now, caveat there, right? I know nobody gets into business just to make money, right? There's always some external or internal motivating factor, whether it's teaching or sharing or, you know, collaborating or contributing to, you know, your community. And that's an incredible driver to motivate yourself, to, you know, put yourself through this, because often, you know, you'd be better off going and working for someone else, right? Especially a small business, you're working 60, 70, 80 hours a week for less than minimum wage. And so you have to have that factor. But to drive that and to justify that, this financial factor enables you to do all of those other things, right? And that's kind of that last reason is, so we've got the external reason of, okay, you know, how do I communicate my business and talk to these other professionals? The internal reason of, how do I make the best decision and move my business forward? And then the internal reason is within you. Saying, okay, what motivates you to get out of bed in the morning, to put out that fire, to deal with that employee headache or the customer or whatever it is? It's not financial, but the financials allow that decision to happen. So long as there's money in the bank account, you can do all of those other things that you want to do. So that's my floor, right? It's saying, okay, let's at least establish some viability so that this is something beyond a hobby. And we can build on that. Right? So to kind of pivot back a little bit to what I was talking about at the beginning, where I'm not a CPA, I'm not talking about filing or taxes. You know, this isn't an intuitive thing. The financials are not the reason you got into business. Nobody starts a business because they love Excel and they want to practice Excel. So you're an operating performer, you're working with your customers, you love what you do. The financials are kind of a necessary evil, right? It's a way of reformatting all of that knowledge that you created, that you generated over your lifetime, and putting it into something that's 1 or 2 pages, right? It's tedious, it's boring, it's sitting behind a computer when it's a beautiful day out, but which I admire you for doing. But the goal is, like any good race car driver, right, to say, okay, you're not designing the engine. You don't have to understand everything about how the engine moves, but you have to know enough and know where to look on your dashboard to say, okay, am I winning or am I losing, right? Am I burning too much fuel, not enough? Am I going too fast? What part of my car is going to fall apart first, right? Where are my weaknesses and my strengths as a driver, be in the driver's seat of this machine to get to the finish line as fast as I can, right? And that finish line is totally up to you to decide what that looks like. But to understand how to drive well, you have to be able to understand how everything works together. And that's going to be our focus today. Any questions so far? I know we're kind of diving right in here, but so the first thing we're going to talk about is just kind of the groundwork. And we're going to talk about, this is basically an MBA in an hour. So the 3 financial statements are the income statement, the balance sheet, and your cash flow. Right? The income statement is an operating performance that looks at what you're doing over a period of time. Right? It's your sales, it's your cost of goods, your overhead, saying how well are you using your assets to generate revenue. It's your performance. Right? The balance sheet is what your business is. It's your assets, it's your liabilities, it's the actual entity itself at a specific point in time. And then the cash flow kind of combines those two. So why bother with this, right? Isn't that kind of overly convoluted? Yes and no. So yes, a lot of business owners just use their bank account. You look at your bank account, you say, okay, there's money, I'm doing well. Kind of 2 problems with that, right? One, it doesn't separate out your performance from your business and reinvesting and how you're using the performance to drive future growth, right? And the second thing is the bank account is retroactive, historic, right? It's all the decisions you've made in the past lead to that bank account in that moment. It has nothing to do with where your business is going. So in terms of like driving, right, you want to be in the driver's seat, not the passenger seat. And we want to be looking ahead and saying, okay, is this the direction I want to be going? And your bank account can't tell you that. Your bank account tells you how well you've done. It has nothing to do with how well you're doing. So by separating these out, we're saying, okay, we acknowledge that the bank account isn't the way to go. It's worked well so far. Maybe it's a good benchmark rule of thumb of, the starting point. But to map out, we have to be able to separate out those 2 activities, the operating from the reinvesting. And then the second reason, again, internal versus external, right, is taxes, right? Your taxes are based on the income statement. So your performance, your operating performance, is what the IRS wants to look at. They don't care what you do with your net income. They just care you pay taxes on it. So, just from a pure tax perspective and understanding how the IRS reviews your business, understanding kind of the separation of financial statements is valuable. So the income statements where we're going to spend the majority of our time today. The income statement, that operating performance, is probably 90–95% of what you do day to day. Right? So usually an income statement is broken out over a month or a year. It's a period of time. And it's everything you've done in that period of time that pertains to your operations. So it's 3 sections, right? Always most important, top, revenue. How much did you sell in that period? And then your costs are broken out into 2 sections. And we'll really dig into why it's broken out that way. But it's your cost of goods and your overhead. And your cost of goods are the costs, the expenses associated directly with the sales. The idea being, as your sales go up, your cost of goods go up. As your sales come back down, your cost of goods go back down. So those 2 things travel hand in hand. And then we've got your fixed costs, your overhead, right? Your rent, your insurance, your administrative, payroll, your accountant, attorney, whatever that is, those are fixed. That is what it is. you don't sell anything in a particular month, you still have to pay rent, you still have to pay insurance, right? So those two things, for the overhead costs, we look at usually as a dollar amount. We're saying, okay, my rent is fixed at $1,200 a month. My accountant charges me, $2,000 a year to file taxes or whatever it is. Your cost of goods we look at as a percent of your revenue. We say, okay, of every dollar I sell, 40 cents goes out the door to ingredients or direct labor to create that dollar, right? And I want to monitor that as a percent of revenue, because it doesn't matter what the dollar amount is, it matters what my value add is. Right? That difference there, that relationship between my sales and my cost of goods is what value I'm creating. Saying, I bought these things for this much, I'm doing something to them, and I'm selling it for more, hopefully, right? That value creation process is my entire operation. It's my business. It's how efficient I am. And because so much goes into that single number, it's easy to track that number and watch it go up and down. And then, a lot of your business decision is saying, okay, how well am I buying my ingredients? Am I working with my vendors to make sure it's wholesale? How well am I marketing and controlling my pricing to drive that up? That relationship, that 1% of revenue line is so much of your business, right? So again, sales, and then we look at our cost of goods as a percent of our revenue to say, what is the relationship there, my value creation? And we track our overhead by saying, okay, what's the dollar amount? How much am I spending? And then what we're left with is called your net income. That's what you pay taxes on typically. It's that little bottom line, a little piece of the pie you get to keep. Talked about this. So you've got all of your revenue comes in, you spend a percentage of it on your cost of goods, controlling that as a percent. Some of it goes out the door as overhead, usually a fixed amount, and then you're left with your net income. So your business, right, all of those decisions we've already been talking about, everything that kind of keeps you up at night that you're thinking about, is really three things here. You're saying, okay, how do I drive my revenue up, get that green as big as possible? How do I control my value add, maintain that piece of yellow as a percent of my green? And how do I control my red, my overhead? Now, the red part usually ticks up, right? You say, okay, it's fixed, and then I have to move into a bigger location. And now it jumps, and it's fixed, and then I have to add, middle management employees, and it's fixed, and it goes up. Your cost of goods is more fluctuates, right? And you're always measuring that relationship between your cost of goods and your sales line. Now, the second financial statement, you probably only spend about 5 to 10% of your time on, because it's usually kind of set, right? It's your balance sheet. And your balance sheet is at a specific point in time, at 11:59 p.m., December 31st at the end of the year. And it's your assets, your liabilities, and your equity. And just like having a house, if I own my house and my house is worth $400,000, that is my asset. And if my mortgage on it is $300,000, that is my liability. And my equity is the difference between those two things, right? Say, okay, I've got $100,000 in home equity. That's the balance part of the balance sheet. Is the assets of your business are always going to be some balance of liabilities and equity. Now, if your liabilities outweigh your assets, your equity is negative, right? You're underwater, and that happens from time to time, and you can play with that. But the balance sheet's a good it's a good measure of how healthy your business is. Okay, my assets being replaced, are they active assets? Am I utilizing my assets as best I can to drive my revenue on my operating side? Are my liabilities controlled? Are they too much for my business or too little? Should I be leveraging up and borrowing more to reinvest in my business, add assets? And how's my equity, right? The dream, right? I don't have any liabilities. My assets are in a good place. I'm taking it all as equity, right? So the relationship between these two is critical. The income statement, all your operating performance, all that activity that you do, everything you plug in day to day, consumers buying, managing your employees, you're replacing inventory, blah, blah, blah. That net income, the bottom line, you can really do three things with, right? It's on your balance sheet. You can go out and you can buy new assets, reinvest in your business. You can pay down liabilities. That's what a bank wants to know, right? Hey, is your operating performance strong enough to support whatever debt you're adding? Or you can take it out as equity. So those two things go hand in hand. My operating performance is doing well. It's strong. I'm producing more than enough cash to support operations. And my balance sheet, what am I doing with that? How am I reinvesting in my business, controlling my liabilities, paying myself back as an owner? And that's, sorry, just reiterate that. I get ahead of my slides sometimes. That's what the cash flow shows. So the cash flow, in some ways, is redundant. There's nothing new on the cash flow statement. It's just reiterating the other two and the interplay between them. And then you've got these last three lines, which are critical. It's your starting cash, your ending cash, and the change in cash. So over my period of time, I can say, okay, my operating performance produced some cash. I used that to either reinvest and buy some equity or buy some equipment, or I paid down my liability, my principal and my liability, or I took some out at its owner's draw. So my net change in cash was this. My starting cash was here. My ending cash is here. And you'll notice that ending cash at the end of every month just becomes the starting cash of the next month. So that's where we start saying, okay, how does this pertain to my bank account? What does this actually mean to my pocket? That bottom line will tell you, right? So if I'm projecting this random business out 12 months and you can count, I've got 12 months and then this last column here is like the end of the year, right? The idea being, okay, that ending cash, if I'm looking forward 12 months and I kind of understand my operations and where I expect to go, and I have these liabilities that I'm paying down. Well, I started with 20,000 in the bank account. That's January 1, right? And at December 31, I have 11,000 in my bank account. So I know, okay, geez, that's the wrong direction, right? Okay, I'm losing cash this period of time. And then my ending cash never dips below zero. Okay, so I'm never going to bounce a check. My bank account's always going to be positive, but I'm going to end the year with less than I started. So I might be able to maintain this for another, 6 or 12 months after this period before, I get in real trouble. And that's why I love financials so much, because you can look forward, right? You can look ahead. I do a whole 4-part series on projections, but if you understand how your operating performance works, if you understand the obligations on your balance sheet, how you have to reinvest to replace assets, your liabilities, right? Then you can look ahead. It's never going to be exact. Right? We never know what the future brings. But if we know more or less, okay, I'm going in the wrong direction and I have 18 months to fix it, that is a heck of a lot better than getting a call from the bank and saying, hey, you just bounced your check. All of a sudden, my opportunities for changing my business model are nothing. Right? I've got no time to react. I have no time to change my operations, to control any of those decisions. I bounced a check. Right? I'm scrambling for cash. I'm borrowing from friends. I'm, paying 18% interest on a credit card because I needed to pay a vendor. Right? Your opportunities to improve your business model narrow so dramatically when that happens. So by looking ahead, we can avoid that. Hey, it's not a great direction, but I've got 18 months to fix it. I can start implementing some of those changes, measuring the outcome, right? I know the cost. I want to measure the outcome and make sure I'm moving in the right direction. And again, this is a threshold, right? This is the floor. Is everything that drives you to run your business in this? No, of course not, right? How could it be? That intrinsic motivation that gets you out of bed in the morning, it's not financial, right? But it allows that. We have to at least be able to meet these obligations, to keep the people employed, to keep paying your vendors, to support what you're going through. So effective use, right? I included a slide in here. So this is in QuickBooks. There are 2 ways to look at this. So once you kind of go through this process and you can put together projections, or we can help you, happy with that, you can put your projections right in QuickBooks. And you can run this report. So if you go to tools, budgeting, you can plug it in. It takes 5 or 10 minutes, depending on how long your chart of accounts is. But you can run this report, budget versus actuals, and it lays it out for you. So if I, finish a month, I can run the report. And as an operating owner, I don't want to spend a lot of time looking, digging through the haystack trying to find the needle. This report says, okay, side by side. Here's where you thought you were going to be, and here's where you actually are. That's in line, that's in line, that's in line. Okay, this is out of line. This is where I need to focus my time, right? If everything's in line, great. I'm doing better than I thought I was. Forget it. I'll worry about it next time, right? Get back to doing what you're doing. Get back to doing what you like to do, right? I like the financials. It's rare, right? You are better at the operating performance. You are better at the customer relationships. Go do that, but make sure you're doing it effectively, right? That's what this is for. And then you have this other report that I highlighted, profit and loss comparison, which kind of does the same thing side by side, but you can compare to prior year, right? So two benchmarks you can hold yourself accountable very quickly. Am I doing better than I did last year, year to date, or in this month? Am I doing better than I thought I was going to against my budget, year to date, or month to month? I am, great. Okay, let's move on. Let's forget about it. Keep doing what I'm doing. If I'm not, why not? Right? Where am I missing? Where should I focus my time, my energy? Sorry, I just saw chat. Okay. Yes, we do have some discounts for QuickBooks, so reach out to us if you haven't. There's also a program, if you have like a simple financials, there's a program called Wave, W-A-V-E, which is a free, very basic kind of accounting software you can use online. So both of those options. Sorry. Told you I'd check the chat occasionally. So key metrics, right? So we understand the income statement, which we're going to talk about, how the income statement's used to fund the balance sheet and then the cash flow. So that's a very, rough overview, why it's broken out the way it's broken out, where you should focus your time and energy, and how to use these financial statements for you to drive your decision making. And Kelsey, you can respond to Katie, but any of your advisors would have a discount for QuickBooks. And it's not a huge discount, but we can get that for you. So if you haven't registered for advising, there's your impetus to do so. So let's talk about break-even points, because I think this is a really critical point, again, for how you can use the financials to drive your performance and drive your day-to-day operations. So just very simply, let's talk about the income statement. So if my cost of goods is 30% of my revenue, which is fairly common for like a restaurant, right? Ingredients at a restaurant are usually around 30-ish%. That means my profit margin, my gross profit, is 70 cents. The inverse of that. Just saying, okay, if every dollar I sell, it costs me 30 cents to make that dollar, and I keep 70 cents to put toward my overhead. My overhead is $150,000. I can very simply say, okay, if I need to have 70 cents of every dollar, and I have $150,000 to cover, then 150,000 divided by 70 cents gives me my break-even point. The amount of sales I have, where 30% goes out to cover creation of the sales, and 70 cents covers my overhead. So that math, it's 214,300. Doesn't really matter. But the idea being, if I know my overhead, which easy to project, right? Usually pretty fixed, usually historical, and I know my cost of goods margin, my idea of, okay, what's my value add or my, markup, whatever it is, then I know what I have to sell to cover those two. Right. Revenue is the hardest thing to project, absolutely. And so I always like to start with break even, because we have to at least cover the cost of operations. We have to stay in business. So what this helps with, right, from an operating performance is to say, okay, if I know, I need to hit $215,000, and I know my average sales per customer, then I know exactly how many customers I need, right? And I can use a seasonality factor. If I want to apply that, I can break it down by week or by weekend, if you're, a strong weekend or during the week, and I can get an actionable goal. I can say, this is my weekly sales goal. This is my weekly number of customers that I have to cover my costs, right? So now, instead of looking at everything, looking at this huge financial report, trying to figure out what your bank balance is, you just know a number of customers, right? That's your Post-it note that you put on your computer. And at the end of the week, okay, did I get 50 customers? Good. Did I get 49 customers? Bad, right? There it is. That's all it is. That's as simple as it becomes. Say, okay, all of that information, my overhead, my cost of goods, my controlled variables, blah, blah, blah. How many customers do I need? Right? So it doesn't take that long to be able to put that together and at least give yourself an actionable goal, or, your sales agents, or, your employees. Right? Who's driving that number, and how apparent and clear are you communicating that that's the expectation? Now, some ways that's not enough, right? To simply say, okay, that gets me to 0. Well, I'm not reinvesting in my balance sheet. I'm not buying new assets. I'm not paying down my liabilities. I'm not taking any owner's draws. That's kind of unfortunate, right? So how do I factor that in? Just count it as overhead, right? So if my overhead is, $9,000, and I want $10,000 a month to put into my balance sheet to reinvest or to take out, then I'm just going to call my overhead $19,000, right? My gross profit margin is exactly the same. I'm still keeping as many cents as I kept before. I'm just dividing it by a larger number. Now I have, another way of saying, okay, it's not 50 customers that I need to get to break even. It's 75. And when I hit 75, not only am I covering my operating costs, but I'm reinvesting in my business. I'm paying down my liabilities. The bank's happy, I'm happy, and I get to keep, enough to have a good Christmas around the holidays. So that's, to me, like, that's the easiest way to look at all of this information. It takes some time to kind of go through it and understand what your fixed costs are, understand what your obligations are to your balance sheet. But you can do that, right? That's all information that's readily accessible. And then that cost of goods margin is just a very simple way of saying, what is your value add? And some businesses don't have any cost of goods, right? If you're a service-based business, okay, you can do it all yourself. You don't have to buy ingredients. You don't have materials. You don't have manufacturing labor out there, producing X number of widgets. That's fine. It's all just overhead, but the calculation's still the same. Right? Okay, for every dollar I keep, every dollar I make, I have a dollar to put toward my overhead. What's my overhead? How do I get that dollar? Right? How many customers do I need to cover these costs? And then, you can even use it to calculate impacts. When we talk about making decisions, you can use this to say, well, if I have this advertising opportunity, it's a $10,000 investment. Well, I don't just have to do $10,000 more in sales to cover that, right? That's the quick logic that's incorrect. Because remember, for every dollar you sell, X% goes out the door to create that dollar. So you have to divide that overhead cost of 10,000 by your margin. You actually, that 30-70 ratio, you actually have to sell, 14,300 in sales to cover a $10,000 investment in advertising. And that's just to break even. That's just to justify it. So all of a sudden, it's like, okay, well, am I actually going to do 15,000? Am I going to do 20,000? It's a cost and an intended outcome. And make sure you're measuring that intended outcome correctly, because 10,000 does not cover 10,000 when 30 cents of every dollar has to go to create the product you're selling. So industry metrics are another great tool. We're going through this really quickly, but so when we talk about back here, the income statement, one of these things that is very useful, and you'll see here where I've broken it down, we have income statement, which is your dollar amount here, 350,000 in sales, 175,000 in cost of goods, 145,000 in overhead. And then I have this column, which is percent of revenue, right? Valuable when you're talking about your cost of goods and measuring your cost of goods. In this case, 50 cents of every dollar I make goes out the door to cost of goods. And you can use that against your historic performance, that year-to-year comparison, and you can use that against your budgeted performance. We can talk about it in more detail if you want. And you can use it against industry averages to say, okay, in my industry, what is effective? What is useful? And why that's so useful to you is because it can highlight opportunities for growth and improvement, and highlight opportunities where you do really well, right? So just for example, right, if my cost of goods here, including materials and direct labor, is 50%, and I'm a restaurant, and I look at the industry averages, I know that average labor is between 25 and 30% direct labor, and average, ingredients cost, materials cost is around 30%. So usually it's like 55 to 60%. This is a healthy restaurant, right? I'm at 50%. So all of a sudden I'm saying, well, geez, I'm managing my costs, my markup well, I'm managing my labor well, I'm producing a lot of food with the labor force that I have, I'm managing my pricing well. I don't need to spend that much time in those areas. The more time and energy I invest there, diminishing returns. Right? I'm already well above the industry average. But it's equally important to know that if I'm thinking about selling my business. Now that becomes a value proposition. Hey, my policies, my procedures, my staffing, my pricing are better than the industry average. I can demand a higher, market price for my business because I'm doing better than most restaurants. I'm, superior. And it's that number, all that hard work, that effort that you've done in creating those policies and procedures, that's where it flows through. That's what convinces a buyer that there's goodwill in your business, right? Is that it converts to a financial presentation to say, I'm better off than your average restaurant. You want to go buy a different restaurant? Go ahead. You want to buy my restaurant with these procedures, this staff in place? Okay, it's going to cost you because I'm significantly more profitable than your average restaurant, and you're going to get a higher return on your investment. Okay, that makes a lot of sense, right? So, yes, you can look internally, compared historic performance. You can look against your budget, where you expect to go, and you can look against the industry as a whole. Those are three great ways to say, okay, where can I improve my time, my effort? So, like-kind statements, that percent of revenue, cost of goods is very common. Advertising, wages, rent, usually you can find within your industry specific percent of revenue for each one of those, right? Because the idea of being advertising should be universal. If your advertising dollars are converting to customers, then that relationship should be something you can compare from one business to another. Rent, how well are you utilizing your space? How well is your location? Central to your customer base? Do people have to drive out of their way? Where's the conversion of that cost of space to customers? Again, that relationship is a percent of revenue. So these are all things that you can use to kind of say, am I doing well or poorly? And where can I focus my energy, my effort to improve my business? And then revenue metrics, right? Every industry is specific. Happy to kind of dig through that. Any of the advisors with the SBDC staff can do that with you. You can kind of say, okay, what is the revenue metric for your business? And again, it's one rule of thumb, right? There's so much variance, but the idea is, what's a starting point that can drive your behavior and drive your decision process to improve? And if you're doing better than the industry average, great, right? Like beating your budget or doing better than last year. Okay, move on. Go back to doing what you're doing. You're clearly good at it. But if you're missing somewhere, this is a great way to reflect on that and say, okay, how can I get that in line? Right? Cost of goods is so huge because if you think about it, right? If I'm a $1 million business and my cost of goods is 5% off of the industry average, what is it? That's $50,000. Right. So if I get just within to the industry average, I'm putting $50,000 more to my bottom line. What can you do with that? How can you reinvest that? You want to go buy more assets? You want to pay down some liabilities early? You want to take a nice, healthy, $50,000 bonus of the year, the end of the year? Focus your time and effort where it matters the most, right? Switching from double ply toilet paper to single ply. It's not worth the energy and effort to do that. But if you can get 5% less on your cost of goods, that all falls to the bottom line. And that's going to last, right? And local competition, right? This is another way to kind of measure that top line performance, right? If you're projecting out revenue and you're trying to figure out Am I moving my revenue in the right direction? You know, if I add this service, this product, your local competition is probably the best way to get that idea, right? You can use industry benchmarks. Most of these are national or at the very least regional, right? Like New England, maybe you can get. Local is local. So go take an hour and sit across the street and count the number of cars going in and out, right? Make sure your pricing is in line, or if it's not, why not, right? Can you make the case for a higher quality customer service or higher quality end product? And how are you communicating that with your customer base to say, yes, we cost more, but in exchange, we're doing this, right? We covered a lot of ground. But I think, you know, I just want to hop back again to this, right? This drives your business. This is what your business is. Your operating statement, your income statement is all of those decisions that you live with and act on every single day. And it should have at least a positive impact to your bottom line, or at least neutral. If you're giving away revenue, if you're giving away a margin, if you're spending more than you need to on your overhead, you better have a very solid long-term goal as to how that will be mitigated, right? Because otherwise, you know, it's a hobby. Right? I hate to put it like that. I know you put a lot of energy and effort and love into your business. But if you don't have a bottom line, if you don't have a strong enough net income to support your balance sheet, then you will go out of business. So that's some of the tougher conversations we have. I don't want to end on that, so I'll probably fill in with some other information in a moment. But the idea of I have to employ these people, I have to serve this community, will only go as far as the bottom line allows. Right? If you put yourself out of business to serve the community, then you will no longer serve the community. If you put yourself out of business to employ people, you will no longer employ those people. It has to start with understanding where your business is going, ensuring that it is viable, and that empowers you to do everything else. So if you miss everything else that I've talked about so far, if it's all too much or too convoluted or it's too beautiful out, that's totally fine. I understand that. But at least understand how your operating statement and performance, that net income, funds your balance sheet, and both of those things act together to affect your cash flow. All of your decisions have a cost, right, and an intended outcome. Rule of thumb for intended outcome is that it is twice as costly and half as effective, right? So if you're investing in something, if you're taking a risk, cut that outcome in half, double the cost, whether that's time or, you know, expense. And if it still makes sense, then do it. But don't let optimism get in your way of success. I'm actually going to, because I've got time, and why not? Well, hold on. So let's just make sure I'm hitting these things. So tips and afterthoughts, learn the language. You know, this is all stuff you already know. That's something I haven't hit enough, right? You live this, right? You're driving the car, whether or not you understand how it works. This is just kind of peeking beneath the hood and understanding a few of those parts moving together, how that affects your efficiency. So don't get overwhelmed, right? This is all information you already know intuitively. It's just a slightly different language. It's saying, okay, I know my markup, I know my margins, I've measured that. I've just never bothered looking at it in a spreadsheet, right? And it was 31% last year, and then 32% at the end of the year, and then 33%, and now it's 34%, right? As my percent of revenue. So wait a minute, I've lost 5% over the last year and a half. I should revisit that. Maybe I need to revisit my pricing. Maybe I need to talk to my vendors. But it's that kind of change over time analysis where those things creep away, right? And like I said, 5% of $1 million is a lot of money that you can put to the bottom by controlling that and just making sure it's in line with where you expect it to be. So learn the language, understand these reports. It's easier than you think. And the more you practice, the easier it becomes. Industry benchmarks are, again, a great way to just kind of say, ballpark, where should I focus my time and effort? is there opportunities for me to make significant improvements, or is this going to be an uphill battle of little incremental improvements? Both are important, right? It's the arms race theory, right? You're racing to stay in one place, right? But if you can say, okay, focusing my time here gets me this much further forward than focusing my time here, great, I'm going to do that, and then I'll refocus on the other thing. There's only so many fires you can put out. There's only so many minutes in a day to be spent on these things. So make sure that that time, that effort, that money, that investment that you have has the highest bang for its buck. And I'm going to share another thing in just a moment to kind of talk about that. It's third bullet point here. Your chart of accounts is what that left column is, with all everything kind of categorized. So looking at this, right? Revenue, sales, service, total revenue, cost of goods, materials, direct labor, total COGS, overhead, rent, insurance. That's called your chart of accounts, right? And that is created by you. And every time you enter something, you either select one of those chart accounts to drop it into, or you create a new item, and that chart of accounts grows organically, right? So that is a very quick way to kind of lose the forest through the trees. Rough rule of thumb, your chart of accounts should be 1, maybe 2 pages. That allows you to run those reports quickly, identify where things are hitting or missing. So don't have like other miscellaneous, other office, other, if it's rule of thumb, right? If that percent of revenue column is less than 0.5%, it should probably be nested in another category. Again, not an accountant, but just as an idea of, okay, am I focusing my time where it matters? Doesn't matter if my company is using K-cups or, a coffee pot. I guess maybe you're probably spending a little bit more on the K-cups, but as a manager, is your time best spent doing that, or is it best focused on the big items, right? So this is meant to run your business out of. So control that, understand what that chart of accounts is saying, and how do you use it for yourself to say, okay, what do I want to see when I look at it? One of the most common questions we have is, what is considered a cost of goods? Well, I've got, 2 employees, are they really cost of goods, like, producing labor, or is it overhead? Totally up to you, right? Not the answer you want, but how is it best used for you? How do you want to measure it? Yes, it's useful to have it kind of tied to the industry if you're looking at industry averages, but the best benchmarks to improve your performance are the historic and the internal. So if you're looking at something and you know right away what it is and where you put it, do that, right? If it makes sense to you, that is the rule of thumb. Do that first. And then consistency, right? Anytime we measure 2 things against each other, if they're inconsistent, then we can't, right? So make sure you're putting the same expense in the same bucket so that when you compare year to year, you know exactly that those things are accurate. And if they're accurate, then you can pull lessons from them. If it's inaccurate, then no conclusions can be drawn about whether it's gone up or down. Don't fall behind on QuickBooks entry. Usually 5 to 10 maybe business days after the end of the month, you should have that closed and reconciled against your bank account. You can use a bookkeeper to do that, but our conversation today, when we're talking about operating owners, again, it's easier to do that and stay on top of it, even if you're paying someone else to do it, and then have those reports be timely. Right? My cost of goods went up 5%, and I don't realize it for 6 months. That's a long time to be dragging my feet and spending more than I have to, or having my pricing be out of line, or whatever the cause is, right? So understand timeliness is critical. And because I've got a couple more minutes, I'm actually going to share one other thing that I use personally, but it's a way to kind of categorize all the things that I have to do and have a quick comparison. And of course, I'm trying to talk while doing something, so bear with me. So the ICE method, right? The ICE method is impact, confidence, and effort. And so Again, as an operating owner, you've got 100 different things you're trying to make a decision on at any given time. They all have costs. They all have intended outcomes. You've got a lot of things on the back plate that you want to get around to, but you never quite have. This is a great way for me to kind of compare some projects quickly and say, I only have 80 hours a week before I pass out. I only have this much money allocated in my advertising, marketing, or research and development budget. What do I need to do, right? So impact, confidence, effort, right? How big of an impact is this going to have on my business? Is this the toilet paper analogy, single ply and double ply, or is this a 5% change in my cost of goods? Right? That's my intended outcome. 1 to 5, right? Game changing, very limited, small, small dollars. 2, confidence. How confident am I in that impact, right? Am I sure that this effort, that this is going to make a huge change, or could it make a huge change, or could it have no impact at all? I'm kind of rolling the dice, right? I'm not very confident. So again, measure very simply 1 to 5, not confident, very confident. And then effort. How much time or money does it take me to do this, right? Is this a 6-month project, or can I knock this out on a Friday afternoon, right? Is this a webinar that I can attend, half pay attention to, and maybe watch the recording up later? So easy, hard, right? Short-term, long-term. Each one of these, impact, confidence, effort, you can score very quickly, and very quickly I can say, okay, where should my time and energy be focused? What's going to have the greatest impact with the least amount of effort and that I have the most confidence in? Again, is this oversimplifying everything that you do? Sure. But is it a quick way that I can say, okay, I've got this finite resource of my time, of these 4 projects, which makes the most sense to kind of whittle away on today? Yeah, it's a way to kind of put that into an analytical format. And if nothing else, I like analytical format. So this works well for me. I think that's actually all I have, which is good. We covered a ton of information, and hopefully your silence doesn't mean you're overwhelmed by it. But if there are any questions, I would welcome them, either taking yourself off mute, dropping them in the chat, or sending an email after the fact. And I think hop back on the slideshow.
Well, thank you as always, Raynor. It's just amazing how much information you have in your head about this kind of stuff. So I'm always amazed. Lots of people are saying thank you, great, fantastic. A couple of people had to jump off early, so they were excited that we're sending out the slides. One question that wasn't answered is, when does it make sense to start building financial statements if it's super early on and there are no sales on the books yet?
Yeah, I would still track it because, again, your overhead costs, you're spending, right? And again, if you've created an LLC, if you're filing as a sole proprietor, those are costs of the business. You'd be overstepping a little into accounting territory, but as expenses of the business, you should be tracking that because those are tax deductible, right? Those are pre-tax expenses. So if you're tracking that and you're showing that, even if it's pre-revenue, you're technically a business, you're spending money on it. And so that would either count as owner investment that you were making in the business and should be on the balance sheet, or I think you can track it as an operating statement and have it be tax deductible once you start having revenue coming in. I think I'm overstepping there, so check with your accountant, but sooner the better. I am confident in that answer.
There you go. Another question from Alberto. Currently working on my food startup here in Maine. The finance part is the one area that I need help with. Is it possible to do a rough draft my entire business expenses with a forecast sales to calculate if I will be making a profit, or is it even worth continuing this journey? Yeah, that's like your financial projections thing. Isn't that like your favorite part?
Yeah, and absolutely. So if you're thinking about starting a business, yes, right. So 2 things, right? So a business plan, if you're looking to borrow money, then the business plan is written for an audience. Right? That's key. And if you're borrowing money, then that business plan is written for the lender. If you think about the format of a business plan, it's really designed to answer all of the assumptions you're making, right? So your overhead's the easiest to predict. You know what those are. You've probably identified a location. You can get historic utilities, so you know rent and utilities. You can get a quote for your insurance right now, so you know what that cost is going to be. You know, you can probably talk to an accountant, an attorney, get quotes for what their, annual legal professional fees are, whatever it is, right? So your overhead is fixed, and you probably can get 90 to 95% accurate on that right now. Your cost of goods is, that relationship of saying, okay, if I sell, this plate of food, I've measured it out, and I sell it for $15, and it costs me, $4.95. This is my cost of goods margin, right? And at this number of plates that I expect, I need to have this number of servers, this number of wait staff, and so on. So that's my labor cost. So what we're doing is we're starting with your projections at the bottom, and we're working our way up that income statement. We say, okay, operating costs we know, cost of goods we know more or less as a percent of your revenue. Revenue we can't predict, but we can understand how much we have to sell to cover those costs, right? And if you look at that kind of break-even analysis, that part of your business plan, that's probably 60, 70% of your business plan, is marketing and advertising. It's target demographic. It's price plating. It's how big your restaurant is. It's all about that top line. It's saying, how are you getting butts and seats? Right? At this price point compared to your competitors in this target area with this number of people driving by every day, and with this investment in your advertising and marketing, I can justify this number of sales. And with that number of sales, I can cover all of these costs. It's a balance, right? You want to show that you can support the balance sheet, that you can pay back the bank if you're borrowing money for that. So you have to at least show that you're going to get to break even. But it's under promise, over deliver, right? Good lender relationship, good spousal relationship, good partner, under promise, over deliver. So you want that to be conservative. You want that to be achievable for you. And you want that to be, in essence, net positive, that you're still at least breaking even and coming out of it. Does that answer your question? Okay.
I would guess so, but Alberto, let us know if you have follow-up questions. It seems like we had a lot of new to the SBDC participants today. So welcome, everyone. We're so glad that you found us one way or the other. But I've put in the request advising link in the chat a couple times, and I'll include that in my follow-up email. So everyone should go ahead and just sign up for advising. It won't cost you anything. We can answer your basic questions. We can answer your complex questions. And we would love to help with all of this.
Yeah. Hold on. Is that another great?
Big ones. Currently in the process of gathering information, making a list of tasks to complete prior to launching insurance agency. Yeah. What would be on your checklist starting your first venture? Ironically, tomorrow we have a startup checklist webinar at 1 o'clock, 2 o'clock. I'm not sure what time it is. It's at 2 o'clock. So you quite literally have a checklist. I will put that link in momentarily, and it will actually also be in my follow-up email. Love that cross promotion.
Yeah. And we do all kinds of webinars like this, but like Kelsey said, and I'll put it out there again, we like the one-on-one stuff because then I can stop speaking in generalizations and really be a little more specific. And that's fun, right? So if you have questions that weren't answered today, or if you're thinking about something in the back of your head and you're not able to quite formalize the question, but it occurs to you later, reach out. Right? That's what we're here for. That's the sweet spot for us, is to kind of help you. So keep in touch.
I want to make sure that you just see or hear this comment right now, but someone said, very clear presentation. You've really piqued my interest in financials.
Oh, go on.
Awesome. Well, thank you so much as always, Raynor. It's incredible how much you know about this. Thank you to everyone who joined us. We hope that you will get set up with an advisor, and we hope to see you at future events as well, hopefully tomorrow.
Thanks all.